You know that feeling when you look at a company's financial report and it's just this wall of numbers and jargon? It feels like trying to read a totally different language, right? Well, guess what? It is a language. Accounting is literally the language of business. And in this explainer, we're going to demystify it. We're going to translate those complex rules into simple ideas so you can understand what a business is really saying. So let's learn how to speak business. I mean, think about it for a second. How does any business, I don't care if it's a tiny coffee shop on the corner or a massive tech giant, how do they actually keep score? How do they know for sure if they're making money, if they can afford to hire someone new, or if they're about to run into some serious trouble? The answer to all of that is in the financial story they tell.
And that right there is the key idea for today. Let's stop thinking about accounting as some scary math class. Instead, let's treat it like a universal language. It's the structured, official way a company communicates its performance, its health, and its potential to the entire world. It's the ultimate scoreboard.
So first things first, let's really dig into what this scoreboard is all about. What's its purpose? Why does this whole system even need to exist? Okay, this definition is actually pretty cool when you break it down. It's not just about crunching numbers. It's a whole process. It starts with recording every single financial event that happens. Then you have to classify those events, put them into the right buckets. After that, you summarize all that data into easy-to-read reports. And then comes the most important part. You interpret what it all means to help people make much, much smarter decisions.
And who are those people making the decisions? Well, they kind of fall into two big groups. On the inside, you've got the owners and the management team. They need this info to plan budgets, figure out where costs are too high, and basically steer the ship. But then you have the outsiders, the investors deciding if they should buy your stock, or the banks trying to figure out if you're a good bet for a loan. Both groups are reading the exact same story, just for totally different reasons.
All right, so if accounting really is a language, then just like any other language, it's got to have rules. You can think of it like a financial grammar that everyone agrees to follow. It's what makes sure the story is being told the same way every time so we can all trust it.
So let's get into it. What are these foundational principles that make the whole system tick? And these aren't just, helpful suggestions. These are the core rules that every single transaction has to play by.
The first rule, and honestly, maybe the most important, is this. The business is its own person. It is completely separate from its owner. So, if the owner uses the company credit card to buy groceries, that's not a business expense. Nope. The business treats it as the owner taking money out for themselves. This separation is absolutely crucial if you want to know how the business is actually doing.
And here it is, the single most important formula in all of accounting. I want you to picture a perfectly balanced scale. On one side, you have everything the business owns. And on the other side, you have everyone who has a claim to what the business owns. And here's the magic part. This equation must always be perfectly in balance, no exceptions.
So let's break that down into plain English. Assets, that's all the stuff you own. Think cash in the bank, your delivery van, the computers in the office. Liabilities, that's what you owe to other people, like a loan from the bank, or that bill you haven't paid yet. And capital? Well, that's what's left over. It's the owner's piece of the pie.
Let's make this super simple. Our coffee shop. Its assets are the big, fancy espresso machine and the cash in the drawer. So, how did they get that stuff? Well, they got a bank loan. That's a liability. And the owner put in some of their own savings to get started. That's the capital. See? It balances perfectly. What you own is always balanced by what you owe to others and what you, the owner, put in.
Okay, so we've got the rules down. Now let's see how this language actually works day to day. How does something as simple as selling one cup of coffee make its way into the company's official story?
It's basically a three-step journey. First, a transaction happens, some kind of financial event. Then that event gets recorded in order in the journal, which you can just think of as the business's daily diary. Finally, that diary entry gets organized into the ledger, which is like a big filing cabinet that sorts all the entries into specific accounts, like cash or sales.
And that's the key difference right there. The journal tells you the story of what happened each day, from morning to night. But the ledger takes all those daily stories and files them away neatly, so you can just flip to the cash folder and see exactly how much cash you have at any moment. You really need both to see the whole picture.
But here's the big question. How does that accounting equation stay perfectly balanced after every single sale, every purchase, every bill paid? The secret is something called the dual aspect concept. This is the engine that makes all of accounting go. It just means that nothing comes from nowhere. Every transaction has two equal and opposite effects. If you get something of value, you have to give something of equal value.
And this slide shows that idea perfectly. You sell a coffee for $5. So, what happens? Two things. First, your cash, which is an asset, goes up by $5. Great! But at the exact same time, your revenue, or your income, also goes up by $5. An asset goes up, and the owner's claim on those assets also goes up. The scale stays perfectly level. It's beautiful, really. So we've covered the why, the rules, and the how. But let's zoom out for a second. Why is it so incredibly important for a business to get this language right? Why does it matter so much?
Because at the end of the day, all this work isn't just about keeping the government happy at tax time. It's about giving leaders the clear, reliable information they need to make huge strategic decisions that are going to shape the entire future of the company.
Here's a perfect example. Our coffee shop owner needs to spend some money. Buying a brand new, state-of-the-art oven is a capital expenditure. It's a long-term investment, so it gets recorded as an asset. But buying flour to bake today's croissants, that's a revenue expenditure. It's a daily operational cost, so it gets recorded as an expense. The language of accounting helps distinguish between the two, which gives a way clearer picture of what's an investment versus what's just the cost of doing business.
But we have to be honest, this language isn't a magic crystal ball. It has some serious blind spots. For one, it has no idea how to put a dollar value on a company's amazing reputation or a really toxic work culture, at least not until it's too late. It's also based on what you paid for something years ago, not what it's actually worth today, which can be misleading. And it involves a surprising amount of human judgment and estimates, which means the story isn't always 100% objective. It's powerful, but it definitely doesn't tell you everything.
So, when you put it all together, what do you get? You get a story. By following this strict set of rules, accounting creates a detailed, verifiable history of a business's financial journey. It gives leaders this incredible map of where they've been and how they got there.
And that kind of leaves us with one last big question to think about. If this powerful language is all about creating a perfect record of the past, how do leaders use that historical map to navigate the complete uncertainty of the future? That, right there, is the bridge from accounting to finance. But that's a story for another time.